For more on inflation and the Fed, let's bring in Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. Savita, great to see you. I'm going to ask you the same question that I asked the traders just a few minutes ago, and that is, what does the 10-year yield tell us? Because you say that is actually the key determinant in terms of the direction of markets, not Fed funds rates, but the 10-year yield.
Yeah, I mean, our premise has been that this laser focus on the Fed is really misplaced, because what's more important for equity performance, and in particular for the S&P and the NASDAQ, is the long end of the curve. So everyone's hoping for a pivot, praying for a pivot. I don't know if this makes sense on the short end, because what we've found is that historically the worst time to be in equities is when credit conditions are tighter and the Fed is easing. It smacks of desperation. And our view is that we are going to be in a tightening credit condition environment in the first half of next year. Now, look, I mean, one thing we're realizing is that everyone is bearish now. I mean, the world is talking about everything that can go wrong. Everyone thinks earnings are too high. So I do think that there are reasons to be invested in this market, and you can't be out of equities completely. But I think that the focus on inflation and the Fed is likely to shift towards the real economy, to real rates, to growth prospects. I think inflation is going to remain high and stickier than folks are currently penciling in. I mean, I think what's interesting is that the market right now, and I would love to hear what everyone on the panel thinks, but the market right now is pricing in very low inflation, a reversion back to like the 2% heyday that we had for the last 10 years. And I don't think that's the case anymore. I think we're in a reset where inflation is going to stay a little bit higher, let's call it 4 to 5% for a longer period of time. So those are the things I think we need to brace ourselves for and think about as we move into 2023. The idea that we're not in this isn't the same show that we watched for the last 10 years. We don't just want to pray for.
Savita, I've heard you talk about the new leadership, once we do come out of this, is never the same as the old leadership. We're looking at technology now that doesn't have the same multiples that they had during the tech bubble. So is it the same thing that you could say back then as is now?
Look, I think tech is a value trap. I mean, I think it looks cheap because prices are falling faster than analysts are taking down earnings expectations. It has all the hallmark characteristics of a value trap. And we saw this with financials in 2007, 2008. Financials looked dirt cheap, and everybody thought, okay, it's time to step in. But it wasn't, because it was just a reset. It was the question of, are these earnings actually supportable? And I think for technology companies, they're facing a lot of headwinds that were tailwinds in the last cycle. They're going from globalization and a frictionless supply chain environment to protectionism, and they need to spend a lot of capex to move stuff back to the U.S. or out of China. Tech companies are also facing more regulatory risk. I mean, when you look at data privacy issues and regulatory issues that are starting to creep up for the sector, it's not necessarily the sector that it was over the last 20 years. So I think valuations should be lower, and I also think that earnings expectations are too high. So I guess I look at valuations with several hefty spoonfuls of salt for the technology sector, and I think that maybe that's not the factor to pay attention to right now.
Savita, we're putting up your year-end price target for 2023, which makes it look like we're going to be just about flat. But give us sort of the nuance, the curves, and et cetera, of what this next trading year you think will be like.
Yeah, look, I think there's going to be a better entry point for the S&P 500 over the next, let's call it 6 months. And when exactly that moment is, I think the factors you want to watch are earnings expectations. And one of the things that we're noticing is that right now, the earnings revision ratio is falling. Analysts are taking down earnings, but we think that there's a lot more to go. The worst time to be in the equity market is when the revision ratio is falling and analysts are continuing to cut. The best time to be in the equity market is when the revision ratio is below average, hits that trough, and starts to move higher. So I would watch earnings. I would watch just, if companies give negative guidance for 2023, analysts take their numbers down, maybe I would wait another quarter and see how companies do relative to that conservative guidance and whether that guidance was conservative enough. So I think we need to kind of move into maybe after 1Q earnings or, a mid 1Q earnings in order to get a read on whether we've reset expectations relative to the new world that we live in. And then I think, to answer your question, sorry, I think the market could go down and then up. But the problem is everybody thinks that, so it'll probably do the opposite. Here's the idea. If you want to be in equities for the next 10 years, you can buy today and you will make money. If you want to be in equities for the next 5 years, be selective, but you will probably make money. If you want to own equities for the next 6 months, I would be very, very selective. I would look for income, I would look for defense, and I would look for companies that are likely to continue to benefit from this rotation. Energy, you would think that it would be super crowded at this point, given how great it's done this year, but it is still a big underweight. I think energy's got a lot more to go.
Savita, thanks so much. Thanks for breaking it down in terms of time frame. We appreciate that. Savita Subramanian, Bank of America, which all this gets back to, Guy, the point that you're making, the point that we've collectively, I think, have been making probably since the third quarter, that we haven't seen that reset happen yet. No. And we're still waiting for that reset to happen. And we thought that it would, it started to happen, but not as much as it needs to happen.
And it would be healthy when and if it does happen. And what she was talking about, Savita, does extraordinary work, and Dan can speak to this. This is Dan Benton 101 stuff. If you go back and look at his 20 whatever rules of investing from the early 1980s, you don't buy these stocks when they're starting to lower numbers. And that's exactly right. A lot of these names, I'll give you a good example. If our crack staff can put up an NVIDIA chart over the last 6 months, that stock has rallied 55% from the October low. It's still down probably 50% from its all-time high, but given this run, it is still a very expensive stock. So what are you asking yourself? Earnings revisions have to come down, valuations have to come down, and the number of dollars you'll pay for those earnings, in my opinion, needs to come down.
Yeah, I'll just say this. While, the S&P's down 15.5%, the NASDAQ's down maybe 27%, and, again, think about the returns that we had over the last 2 years. This just doesn't feel that bad, and I know it's been upper left, bottom right, series of lower highs and lower lows. I guess my point is, I think the worst is yet to come. I don't mean like we're going to have, like a crash, like down 50% like we had in 2007 or in 2000, the S&P 500. I feel like the fear, we haven't had the fear yet, and I think that's the thing that we need to see more of this kind of FTX stuff. We need to see more of these companies go to zero like Carvana. We need to see more of the excess come out of the market. We need the sentiment to get really bad, and we need the estimates to, like what Guy and Savita were just saying, to kind of back it all up and actually overshoot to the downside and create a scenario where there can be unusual value by taking risk when things feel bad. That has not happened yet in 2022, in my opinion.